They don't ask how much you make. They don't ask what you do. They already know. The moment you walk into certain bank branches, something shifts, subtle, quiet, almost invisible. The tone changes. The waiting disappears. Doors open that weren't there before. And the strange part is, it's not about being rich. It's about crossing a very specific, very calculated line. A line most people don't even know exists. Here's why this matters right now. Over the last decade, banking hasn't just changed. It's split quietly into two completely different systems, one for everyone and one for people above a certain wealth threshold. The same logos, the same apps, the same buildings, but completely different treatment, different rules, different access, different reality. And once you see how that line works, you start to understand why wealth doesn't just grow faster for some people, it compounds differently. Let's start with the surface. Most people interact with banks in a very simple way. You deposit money, you withdraw money, maybe you take a loan, maybe you have a credit card. From your perspective, the bank is a service. But from the bank's perspective, you are the product. Your deposits are their raw material. Your behavior is data. Your debt is revenue. And for the average customer, that relationship is standardized. You wait in line. You call support. You get generic interest rates. You negotiate, if you even think to negotiate. Everything is designed to scale. Efficient, predictable, replaceable. Now here's where the system quietly diverges. Banks don't actually treat all money equally. They segment it aggressively because not all customers are worth the same to them. At around $100,000 in liquid assets, something small begins to change. You might not notice it immediately, but the bank does. You start getting calls, just checking in, seeing if you need anything. Your account is flagged, not as special, but as promising. You're no longer just a user. You're becoming an asset worth cultivating. Still, at this level, the benefits are mostly cosmetic. Slightly better customer service, maybe a waived fee here or there, nothing that fundamentally changes your financial trajectory. That comes later. The real shift tends to happen somewhere between $250,000 and $1 million in investable assets. This is the first real threshold, not billionaire wealth, not even close, but enough to trigger a different internal category: mass affluent. This is where banks stop seeing you as a transaction stream and start seeing you as a long-term revenue engine. Now the behavior changes. You're assigned a relationship manager. You get access to premium accounts. You're offered structured products, managed portfolios, private lending options. And here's the key detail most people miss. The bank is no longer just holding your money. It's actively trying to deploy it, because at this level, Your capital can be used in more profitable ways. Your deposits can be leveraged. Your investments can be packaged. Your borrowing can be structured. You're not just a customer anymore. You're a node in a financial machine. But even here, you're still not at the level where banks truly change behavior. You're close, but not quite inside. The real line, the one that changes everything, usually sits around $1 million to $5 million in liquid or investable assets. Cross that, and you enter a different ecosystem entirely. Private banking. This is where the tone shifts completely. No more waiting, no more generic products, no more standard rates. Now everything becomes negotiable. Interest rates on loans, negotiable. Fees often disappear. Access to investments expanded dramatically. You're offered things most people never even hear about, not because they're secret, but because they're not profitable to offer at scale. This includes private equity deals, as structured credit, bespoke lending arrangements, and tax-optimized strategies. And here's the uncomfortable truth. The math starts working in your favor. Let's break that down. At lower wealth levels, you borrow at higher rates. You invest in public markets. You pay standard fees. Your financial growth is linear, maybe slightly exponential if you're disciplined. But once you cross into private banking territory, the rules bend. You can borrow against your assets at lower rate than most people pay for mortgages. You can access investments before they go public. You can structure your income in ways that reduce tax exposure. And most importantly, you can keep your capital working at all times, even when you spend. Here's a simple example. An average person wants to buy something expensive. They save, they spend, their money is gone. A high net worth client does something different. They borrow against their assets at a low interest rate. They keep their investments intact, still growing. Over time, the growth can outpace the cost of borrowing, meaning they effectively used money without losing money. It sounds almost absurd because it is, but it's real. And it's one of the core mechanisms that separates wealth accumulation at different levels. Now let's zoom out, because this isn't just about perks or better service. It's about asymmetry. Two people can have similar incomes, even similar savings rates. But once one of them crosses that invisible wealth line, they enter a system designed to accelerate their growth, while the other stays in a system designed to extract value. Same bank, different game. And this is where the irony kicks in. Banks advertise accessibility, convenience, inclusion, simplicity, but their most powerful tools are reserved for the few, not because of fairness, because of efficiency. It's simply more profitable to optimize for people who already have capital. So the system reinforces itself. Wealth attracts better terms. Better terms create more wealth, and the gap quietly widens. But there's another layer most people don't talk about: risk. At higher wealth levels, the system offers more leverage, more complexity, more opportunity, but also more exposure. Because the same tools that accelerate growth can amplify mistakes. A poorly structured deal, a misunderstood product, a liquidity crunch at the wrong time. These aren't theoretical risks. They happen, often quietly, and when they do, the consequences scale just as aggressively as the upside. So where does that leave you? If you're below that threshold, the system feels rigid, standardized, sometimes unfair. If you're above it, the system opens up, but becomes more complex, more opaque, and in some ways more dangerous. And that raises a question most people never stop to consider. Is the goal just to cross the line, or to understand the system before you get there? Because the real advantage isn't just access, it's awareness.
And knowing how the incentives work, knowing why the bank behaves the way it does, knowing when a
Premium offer is actually beneficial and when it's just profitable for them. Banks don't suddenly become generous when you get wealthier. They become strategic. And if you're not paying attention, you can still end up playing the wrong game, just at a higher level. So the next time you walk into a bank or open an app or get an unexpected call from a relationship manager, ask yourself one simple question. At what point does the system stop serving you and start recruiting you? And more importantly, if that line is coming, will you recognize it when you cross it? They don't ask how much you make. They don't ask what you do. They don't even ask what you want. Well, because by the time you sit down, they already know exactly who you are, your balance, your spending patterns, your risk profile, and most importantly, your value to them. And in that moment, something subtle happens, not dramatic, not obvious, but real. The system decides how you will be treated. Here's the uncomfortable part. Banks don't treat you better when you become rich. They treat you differently when you become useful at scale. And that line is far lower than most people think. Right now, the financial world is quietly split into layers, not by income, not by job title, but by how much capital you control and how easily it can be used. Two people can walk into the same bank, same building, same brand, same product. But behind the scenes, they are routed into completely different systems. One is standardized, the other is optimized. And the difference between them is where wealth really starts to separate. Let's start at the bottom layer. This is where most people live. Basic accounts, debit cards, credit cards, maybe a personal loan. Everything here is designed for efficiency. You wait in line, you use apps, you talk to chatbots, and when you do talk to a human, they follow a script. Because at this level, you are not an individual client. You are part of a category. Your money is pooled. Your behavior is predictable. Your value is averaged out. The bank makes money from volume, fees, interest, data. It's a system built to handle millions of people at once.
And in that system, customization doesn't exist. Now something interesting happens around $100,000 in liquid assets. Nothing flashy. No VIP room suddenly opens. But internally, your profile changes. You become worth watching. You might get a call, a check-in email, a slightly better tone. It feels like service, but it's actually surveillance with intent. The bank is asking one question: could this person become more valuable? Because if the answer is yes, they start investing attention, and attention is where the shift begins. Move up to around $250,000 to $1 million. Now you enter what banks call mass affluent. This is the first real divide. You're no longer just a user. You're a relationship. You might get a dedicated advisor. Priority service. Access to managed portfolios. And on the surface, it looks like you've made it. But here's the catch. You haven't entered the inner system yet. You've entered the onboarding stage of it. Because at this level, the bank is still testing you. Testing how you respond to advice. Testing how much of your capital they can influence. Testing how much of your financial life they can capture. Investments, loans, insurance, planning. The goal is simple: consolidation. The more of your money they control, the more valuable you become. And then comes the real threshold, usually somewhere between $1 million and $5 million in investable assets. This is where everything changes, not visually, but structurally. Now you're in private banking territory, and suddenly the rules loosen. You don't wait anymore. You don't call support. Support calls you. Decisions happen faster. Exceptions become normal. Fees that once felt fixed disappear. Rates that once felt standard become negotiable, because now the bank isn't just serving you, it's competing for you. And this is where the math flips. At lower levels, every financial action costs you something. You pay interest, you pay fees, you take on friction. Your money works, but slowly. At higher levels, the system is designed to reduce friction and amplify movement. Here's a simple but powerful example. Let's say you have $2 million invested. Instead of selling assets to spend money, you borrow against them at a relatively low rate. Your investments stay intact, still growing, still compounding. So instead of interrupting your wealth, you layer spending on top of it to someone outside the system. That sounds risky, maybe even irresponsible. But inside the system, it's standard because the assumption is different. The assumption is that your capital will continue to grow. And as long as growth outpaces borrowing costs, you win. Now step back and look at what's happening. At lower levels, you trade time for money. You save, you spend, you reset. At higher levels, you use assets as leverage. You access opportunities early. You optimize taxes. You keep the system running continuously. Same effort, completely different outcomes. And here's where the irony becomes almost uncomfortable. Of the people who need the most help optimizing money get the most rigid system. The people who already have capital get flexibility, access, and negotiation, not because it's fair, because it's profitable. Banks don't reward effort. They reward efficiency of capital. If your money can generate more money for them, they unlock more tools for you. If it can't, you stay in the standard lane. But there's a second layer to this, and it's not talked about nearly enough. Complexity. Because once you enter that higher tier, nothing is simple anymore. Products become harder to understand, structures become layered, opportunities come with conditions, and sometimes incentives are not aligned. Just because something is offered doesn't mean it's good for you. It means it's good for the system. A structured investment might look sophisticated, but hide risk. A lending strategy might look efficient, but depend on perfect timing. A tax optimization move might save money now, but create exposure later. And this is where people make a critical mistake. They assume better treatment means better outcomes. It doesn't. It just means you're playing a more complex game. So the real shift isn't just about crossing a wealth threshold. It's about understanding what changes when you do. Because once you're inside that system, you stop being managed and start being positioned. Your money is no longer sitting, it's moving through products, through markets, through strategies, sometimes in ways that aren't immediately obvious. And if you don't understand the mechanics, you can still lose, just more efficiently. So the next time you hear someone say, once you have money, everything gets easier, that's only partially true. Some things do get easier. Access, speed, options. But other things get harder. Clarity, transparency, control. Which leads to a more important question. Not how much money you need to be treated differently, but what kind of system you want to be part of when you are. Because the line isn't just financial, it's structural, and once you cross it, you don't just have more money, you're playing a completely different game. The question is, will you recognize the rules when they change?